So Bruel Electronics company is developing a new product, surge protectors for high voltage electrical flows. The cost information below relates to the product. So direct material, direct labor, distribution. I think we have done this. They are asking what, how many surge protectors? I think we did this, right?
Yes, sir. Same question, but they give half information, so we left the question.
Okay, fine. Okay, fine, no problem. So this is the information, and the company is will also be absorbing fixed cost of this much fixed charge, corporate fixed charge, and how many such protectors must Bruel Electronics sell. That means they are asking about target sales, right?
Okay.
So, yeah. So what is the formula for target sales?
Fixed cost plus
Fixed cost plus desired profit by unit contribution margin. I think
margin.
we did this. So what is the contribution margin? Sales minus variable cost. That is selling price is how much?
Selling price 14.
$14 minus 8, $6. I think we did this.
Yes, sir, but we got 25,000 answer.
Yeah, no problem. So the fixed cost is this,
Desired
and
profit is 8.
fixed cost plus desired profit. This is the 30,000. They want to earn 30,000, right?
Yes, after tax income.
Desired profit is 30,000, correct?
Yes.
This is after tax. So if it is after tax, that means after deducting tax, you got this. This is 60%, right? So 100% is how much? Just calculate. Hello.
50,000.
Yeah. So this is after tax. We are taking before tax. Yeah. Now find out and tell me the answer.
28,033.
So this is the targeted pre-tax income, correct?
Yes.
What's the
Before
answer? Answer is
C. 28,333.3 I got.
okay. So we'll round off to 28,300. Okay.
Okay.
You want to note it down? Shall we move
Yes.
forward?
Just a minute. Done, sir.
Yeah. Okay. A company has just completed the final development of its only product, general recombinant bacteria, which can be programmed to kill most insects before dying themselves. The product has taken 3 years and this much to develop. Following costs are expected to be incurred on the monthly basis for the normal production level of this much pounds of the product. So you are producing this many pounds, and for that they have given the cost: direct material, direct labor, variable factory overhead, fixed factory overhead, administrative expenses. Okay, fixed selling, general and administrative expenses, everything is given. Variable factory overheads is given, fixed factory overheads is given, variable selling, general and administrative expenses are given, fixed selling, general and administrative expenses are given. At a sale price of this much per pound, the sales in pounds necessary to ensure this much profit for the year would be. So they are asking the target sales. Am I right? Yes. So 5.90, they're asking sales in pounds. So we don't know that. We can take X, right?
Okay.
What is the, see, we need to find out the profit, right? So fixed cost plus desired profit we will take, right?
Okay. Operating income.
Yeah, so fixed cost is how much? Fixed cost. Fixed
Overhead.
factory overheads. Fixed selling and distribution overheads. So actually, as per the break even point, the revenue should always be equal to cost, correct?
Yes, sir.
This equation we can use. So they have given like some desired profit they are asking, right? For desired profit of how much?
3 million.
This much profit for the year, correct?
Yes, sir.
So if this is the desired profit, whatever is given, this should be treated as fixed cost. What it should be treated?
Fixed cost.
Because they need to recover this, correct?
Okay.
This is there in the Hawk textbook also. You can see those points.
Okay.
So they have to recover this. So they treat this as fixed cost. What they treat as fixed cost?
From desired
Desired
profit.
profit. So revenue is equal to cost that we have discussed. And if the profit is desired, they want to recover, it is treated as fixed cost because it is fixed, right?
Yeah.
And except this profit, what is the fixed cost given to you?
2 million. Fixed cost overhead.
Fixed cost is given as,
Fixed factory overhead.
yeah, this is the uh, 2 million and this one.
3.5.
And this is, you can see it is per month, monthly basis.
Okay.
We have to convert per annum into 12. What do you get?
42 million.
Okay, this is per annum fixed cost, right?
Okay.
Now, what about the variable cost?
4,50,000 plus 9
We will
lakhs.
take this. We'll take this. Please add. We'll take 450. We will take 9 lakhs. These are all your variable costs.
2 lakh 19. 29 lakhs.
Is it right? Yes.
Yes,
They
sir.
are taking how many pounds? We'll find out per unit variable cost. 2.90, correct?
Yes.
There's a reason why I'm finding it. I'll tell you because I don't know the number. I don't know what is the sales I'm going to do. I'm going to produce, but I
Yeah.
want to find out the sales, right? So I will be multiplying that sales units with per unit variable cost
Okay.
because I need to equate revenue is equal to cost right now to find out sales, correct?
Yes. So variable cost divided by number of units you did.
Yeah, that will give me per unit variable cost.
Yeah. Okay. Right. Sir. Yes.
Now 5.90 into X, the revenue and the cost, as you know, 42, this we have calculated as fixed cost. And we also know that the desired profits what we have discussed right now is also considered as fixed cost, right?
Yes.
This is what we have to earn. Okay, plus variable cost.
20.
So can you find out X value right now?
Yes.
Yeah.
$15 million. X is equal to 15 million. I got
Pounds.
pounds. Okay.
This is the answer. Shall we move
Okay.
forward? You want to copy?
Yes, I did so.
Okay. Next question. A publisher is considering publishing a new textbook. The publisher has developed the following cost data related to a production run of this much. Okay. And that means they have to run the machine, right? The minimum possible production run is this. Publisher will sell the textbook for $45 per copy. How many textbooks must the publisher sell in order to generate operating earnings of 20% on sales, right? And they have development cost, okay, typesetting, depreciation on equipment, general administrative, miscellaneous fixed cost. So you may be knowing all these are all fixed costs, right? And the
Yes.
variable cost, yeah, variable cost would be like kind of, I think commission is a variable cost. Sales staff commission is a variable cost. Royalties are also variable cost, correct?
Okay.
So first and foremost, they have said total cost of production for these copies is this. Just add them once, somebody.
Fixed cost.
Yeah, you just fixed cost, you tell me the total, and also variable cost, we'll add them and see what is the total cost. I think total cost is like given to us. We will try to segregate this and this. We'll try to find out variable cost per unit. Why? Because the question, what does the question say? Number of copies, right?
Yeah.
They are saying that how many textbooks must the publisher sell in order to generate operating earnings of 20% on sales.
Hmm.
So first find out the variable cost and tell me fixed cost is what we can add up.
Can you scroll it down, sir?
35, yeah, 35. This is like, 43 500, and this is like 51, this is like 55 400, and then we add up this one 55 400, 9320,
77,720.
60, yeah, and then 30, yeah, 80 90 100, 104 something, right? 104
One not for 720.
720, yeah.
Fixed cost.
And variable cost 5400, 67,500, 27,000. If we add up, I think 99,900 will get.
Yeah. Right.
We will find out the per unit variable cost. How come we can find out how many copies? 6,000 copies, right?
Yes.
They are producing. What is the per unit variable cost?
16.65.
This is the variable cost, right?
Yes.
$45 is the selling
Number
price.
of units.
20%. So they are asking how many textbooks must publishers sell in order to generate operating earnings of 20% on sales. So operating earnings is 20% on sales. So $45 is the selling price of that 20%, right? So target operating income $9 per book.
Right.
Is it so?
Yes, sir.
So publisher has to now calculate number of textbooks that must sold to meet this target figure. So you know S minus V is equal to C. That means we know the operating income. S minus V minus F, contribution minus fixed cost is equal to operating income. Is it so?
Yeah, yes, sir. Profits.
We know $45 into X minus variable cost is 16.65 into X minus fixed cost.
Right.
Fixed cost we have just calculated, right? 104,720 is equal to 9 into X. Can you find out X value?
Yes. 5,411.88 I'm getting, sir.
Sorry. Sorry.
5,411.88.
5,412 copies. Okay.
Okay.
Next one. Data below pertain to forecast of XYZ company for the upcoming year. Total cost, unit cost is given. 40,000 units they are going to sell. And how many units does XYZ company need to produce and sell to make a before tax profit of 10% of sales? Again, they want sales minus variable cost minus fixed cost is equal to operating income. Isn't it so? So
Okay.
profit should be 10% of sales, right?
Yes.
So that is the profit they have explained to us. So we have to see what is the sales. Selling price is 25
Yes.
and they are asking what actually number of units. So we'll take X, 25X minus, what is the variable cost?
2.
7 plus 4, 11, 11 plus 2,
13.
13, 13 plus 3, 16. Fixed cost is 225 plus 360 plus 225, that is 585.
585.
Yeah. Operating income is 10% of sales. So sales is how much? 25. So 25 into X into 10%. Can you find out the X value?
Yes, sir.
Done.
25x into 10%. Okay.
Yeah, 25X into 10%. Selling price into number of units into 10% of that is the profit. I'll finish this section today till 20th. Okay.
Oh,
So so only last section will be there. We can take up that tomorrow morning.
90,000 units.
90,000 units. Yeah. Next question. A manufacturer produces a product that sells for $10. So selling price is $10. Variable cost per unit 6, fixed cost 12. At this selling price of whatever this value is, the company earns a profit equal to 10% of total dollar sales. So sales minus variable cost minus fixed cost is equal to operating income, because again, assume that there are no taxes and that total fixed cost and variable cost per unit remain unchanged. If the selling price were reduced to this, the profit would be they are asking, right? So I understand what is the profit, but before that we want to know the number of units, how much they are selling, correct?
Yes.
So do we know the number of units what they are selling will take us X.
Okay.
So 10X selling price into number of units minus variable cost is how much?
6x.
6. It's clearly given here.
Yes.
Fixed cost is 12,000 is equal to, it is the target is 10% of dollar sales. So we don't know the number of units. Selling price into number of units, that is X into 10%.
10%.
So can you find out X value?
Yes.
Number of units.
4,000.
4,000 units is the sales they want to do. What are they saying?
Reduced to 9.
Yeah, so they are saying by reducing selling price to $9 per unit. Okay. From 10, they are changing it to 9. Okay. So you know definitely when the price is decreased, it will boost the sales volume. So so it is increasing by 25%, correct? 4,000 into 1.25 is how much?
5,000.
5,000. So the new sales is 5,000. So we'll find the profit as per new sales. So 5,000 into new selling price, sales minus variable cost, 5,000 into variable cost, that is unchanged. They already said this, minus fixed cost, which is always fixed. So can you tell me the profit? 45 minus 30, 15, 15 minus 12, 3. Finished?
Yes, sir. 3,000.
Yeah. You want to copy?
Yes, this time.
Yeah.
Done.
Last question. Then you have to try. Moorhead Manufacturing Company produces 2 products for which the data presented to the right have been tabulated. Fixed manufacturing cost is applied at a rate of $1 per machine hour. The sales manager has had a $160,000 increase in the budget allotment for advertising and wants to apply the money to most profitable product. The products are not substitutes for one another in the eyes of company's customers. They have given 2 products, XY7 BD4, and every detail is given: selling price, variable cost, manufacturing cost, fixed manufacturing cost per unit, and variable selling cost. Suppose the sales manager chooses to devote the entire 160 to increased advertising for this. Minimum increase in sales units of X7 required to offset the increased advertising. That means how much they should earn to offset this expense. So we'll find contribution margin, sales minus sales X7, right?
Yeah.
Sales minus variable cost. So 4 minus 3 is equal to 1, right?
Yes.
So now, they want how much? 160,000, correct?
Yes, sir.
So they want this much, right? So if what they're saying, so if they get this many units multiplied by 1, so they can easily offset this expense, right?
Yes.
So how many units they want?
1,60,000.
Finished. Okay.
Yeah. Yes.
So they can recover the advertisement cost out of that. It's a fixed nature cost, right?
Okay. Just we have to do contribution for XY7.
Yeah, and back substitution. With this we multiply, we are getting that amount. So it's easy to offset.
Okay, sir. Got it.
Okay, so you can try other questions.
Yes, sir, I'll try.
Okay, sir. Tomorrow morning we'll take the class. I'll inform the time to you. Okay.
Okay, sir. Okay. Thank you.
Thank you so much. Thank you so much.